The broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen, and thank you very much for being with me today. Let's see, we've got all our usual friends here. Glad to see you. And I'm sorry I missed you last week. For those of you who were expecting a webinar last week, that was our normal time, but I had an unavoidable commitment. So let me first say hello to our usual friends here. Andrew's here with us, Ben's here with us, David's with us, he's a tutorial guy. You must be ready for another chat soon, David, let me know. Won't you, please? Florian's with us, long time since we've seen you. Florian, glad to have you, of course. Let me see, Gabe's with us over in California. Glad to have you with us, Gabe, of course. He's a tutorial guy. George is with us. Greg's with us. Plenty of Gregs are with us. Greg from Colorado Springs / Texas. I hope that's all working out for you, mate. We probably need to have a talk fairly soon. It's been a while. Justin's with us. Some of you will remember Justin's done so much work for us with his analysis of Danielcode time signals, which you can see on the website. There's 4 links, video links right at the top of the website, which will show you a lot of the comments from our tutorial graduates. Very well worth while listening to. Marcel's with us up in Canada. Glad you're with us, Marcel. I hope you're feeling well. Mark L is with us, of course. No party without Mark. He's an absolute stalwart. Miles is with us here. Norbert, also up in the cold country in Canada. Peter Mack, who's not a day trader. Many other Peters. Good to have all of you with us. Rolf down in Melbourne. Glad to have you back with us, Rolf. You were in New Zealand for a while, weren't you? I don't know if you're back with us or not. Let me know. Ronald's with us. Glad to have you. Steve's with us, and Jerry. Peter. Angela. Okay. Well, many people just coming in. They're a little bit late, but don't worry. It's all happening. So last week, I was in Sydney on the normal my Friday morning, which is your Thursday evening. I was in Sydney for my daughter's graduation as a medical doctor. Very important, because those of you who have been with us a long time will remember that she got her PhD in Doctor of Philosophy 4, maybe 5.5 years ago. And that's the highest educational degree you can get. It's earned by research, and it entitles you to be called doctor. I used to joke with her and call her doctor, and that was going well. While she'd been doing her PhD at Bond University up here in Queensland, she'd also been lecturing, and she was very, very good at it. She absolutely got the gift. Was winning all the prizes for most popular lecturer, most efficient lecturer, etc. And I was pretty thrilled. I thought, well, there's one off my hands. Wonderful career in academia. They pay you great money at the top of the tree, and you get all sorts of perks like additional superannuation that's not available to all of us. It's quite a wonderful package. And she was doing so well there. I thought, that's wonderful. And it's a private university, a beautiful university. Just a pleasure to just go there and have a look at it. And then she said, well, Dad, actually, I don't want to be lecturing in psychology. That was her basic degree. I want to be a doctor. I said, oh, really? I said, you're going from being a lecturer at a prominent university to being a dreaded freshman again. You really want to do this? Yes, I do. So anyway, time has gone by, and she's done her 4 years at medical school, and 2 years of that in Sydney, another year down at Ballarat in Victoria, which she enjoyed immensely. And now we've been fortunate enough to get her back into the Queensland health system, and she actually graduated in December last year. although the ceremony wasn't held until last week. But she now says the degree she completed is a Doctor of Medicine, which is pretty usual to you folks in America. The education system is quite different here in Australia and New Zealand, and almost all the doctors that we have in this country actually get a bachelor's degree. They get a Bachelor of Science, and they have the honorary title of doctor, but they actually have a bachelor's degree. And fairly recently, they introduced a new doctoral degree in medicine, which means you do your normal Bachelor of Science type training, but you have to do a substantial piece of research as well, which upgrades it from a bachelor's degree to a doctor's degree, but it doesn't really matter. But I was saying to Bertie, well, you know, you've been a doctor for 4 or 5 years already. Now you've got your medical doctor's degree. Is there a big difference, and how do you feel? She said, yes. She said, I'm now a doctor who's getting paid. So there you are. She's working in Brisbane, Royal Brisbane Hospital, the second largest hospital in Australia. She's very happy there. It's all wonderful. Okay, so let's move on. That was why I was unable to do a webinar for you last week. And I enjoyed my excursion to the Big Smoke. Absolutely staggering to me. I've managed for the last almost 30 years to avoid living in a big city. And I've been living either in Taupo in New Zealand, right on the Great Lake there, wonderful, wonderful country, New Zealand, or in the Gold Coast hinterland at the Gold Coast in Queensland, Australia, and to just get immersed back into Sydney. And of course, I'm a Sydney boy. I went to school in Sydney, university in Sydney, played rugby, swimming, everything. My whole younger career was in Sydney. But it was a real culture shock after all these years. The sheer number of cars, the sheer number of people, sort of, wow, it's big. And to all of you people who live in big cities, I congratulate you. I'll tell you, I couldn't do it anymore. It's not for me, but well done, all of you anyway. Okay, so we've got a whole lot of stuff to talk about today, folks. So let's get on with it. I trust you can all hear me all right. I haven't had any complaints pop up, so I guess it's all good. Just put a note in the questions box for me that you can hear me all right, if you'd be so kind. Ronald's joined us. Quite a lot coming in a little bit later today. Here we are. Okay. Grand, look at this. Okay. Oh, Anthony D, good on you, mate, who used to be a broker, is now a private trader. And he says, sunny, warm, poolside Chicagoland. Well done, my friend. 10 by 10, says Mark. Even better, all good for him too. And congrats to the daughter. Yeah, she's done an amazing job. Do excuse me. So she's now, I was trying to work out the correct way of writing down all those degrees. She's now a Bachelor of Psychological Science, and then she got first class honours the additional year. Now she's a Doctor of Medicine, and now she's also a Doctor of Philosophy, a PhD. So she's got a mouthful of degrees. Which has been many years of very, very hard work. They're not easy degrees, and medicine's been a grind, as was the PhD, of course. Those are a couple of degrees that they don't hand out on cornflakes packets, unlike law, which these days seems to make me sad that we have so many lawyers who don't seem to have a basic understanding of their purpose in life. But anyway, that is as it may be. So carry on. We'll start off with our usual note that the markets are rational, orderly, and sometimes predictable. And we're going to show you a whole lot of that today. So today, folks, is here the 14th of June, still the 13th of June, where most of you are in the States, and 17 days or 16 days for me to the end of the financial year. So we've been getting bombarded, as I'm sure you have, with EOFY, EOFI type special offers, end of financial year. And it's traditional to put on a bit of a push into the end of the year. It always makes the balance sheet look a bit better. And that's what we're going to be talking to you about. But I wanted to, just in the purpose of what we're going to do, you can see that our aim is always to make your trading safer and more profitable. And next week, Sunday to Sunday, will be a free week. So do take opportunity of it. Do tell your friends. There's a lot of new stuff that we're doing now that even if you were with us some years ago, as I know many of you have been, it's an opportunity to catch up on all the new stuff and see what may benefit you. And we're introducing a new service next week. It's going to be called Tradecraft, and it's going to be a chart-based service where I'm going to take you beyond daily trade signals and into the realm of graded probabilities. So everything we do in trading, of course, folks, is about probabilities. There are no certainties in trading, as there are no certainties in life, but there are opportunities every day. And we're going to show you a little bit more of where we can go with probabilities and get you thinking perhaps about some things you haven't thought about before. So later on today, I'll tell you what our EOFY special offers are going to be and see if they can find something that will improve your trading. And even you people who've done the Danielcode tutorial, where many of you with us today are graduates of the Danielcode tutorial, there's still a whole lot of information. No, you don't need anything better for your trading, but a general concept of the probabilities of markets will make you an even better trader. And we'll work into that as we go. So yesterday, I had my first ride in an electric car. I had to drop off my daughter's car at the mechanic at the BMW shop to try and fix up all of the wonderful hard work it's done over the last 4 years. It's been from Brisbane's been down in Sydney for a year, 2 years actually, 1 year in Sydney, 1 year out in the country at Windsor, and then a year in Ballarat, Victoria, with those 2-hour runs from Ballarat down to Melbourne. Seem to have done an awful lot of work, this car. And I'm a petrol head in the sense that I love driving. If I hadn't been a lawyer, I'd have been a long-distance truck driver. I love driving. I really enjoy driving. Over the years, I've done most of the things you can do with a motor car. I had a CAMS license many years ago, which allows you to compete in organised motorsport. I've done rally driving, pretty much everything you can think of. And I'm a great admirer of motor cars. I think I'm on the Jeremy Clarkson bandwagon. Speaking of which, for those of you, particularly in America, if you haven't heard of Jeremy Clarkson, he's a British motor journalist, but he had some troubles with his network because he took a shot at one of the producers and decked him. So he's been looking for other things to do, and one of the things he's done is a series called Clarkson's Farm. And many years ago, he bought a farm in the Cotswolds in London, in England. This is outside London. And this show, Clarkson's Farm, which for us, it's on a network called Prime, I think. You'll find it. Is literally all of his troubles trying to become a farmer. And I sympathize with that because at various times in my life, I've been a farmer. And not a very good farmer, a Jeremy Clarkson type farmer, where you have the sort of problems that you buy the farm and you say, well, now I need a tractor. And if your brain works the way mine does, you're attracted to a bigger tractor than you need, and one with air conditioning and all the niceties about it. And then you buy the equipment, the harrows, the plows, the spreaders, the seeders, everything else that you need to go behind the tractor, and all of a sudden you find that your equipment is too big for the gates on the farm. And I've been through all of that, and Clarkson's farm, that's what it's about. But if you haven't seen it, do get onto it. It's really enjoyable. I don't watch much television, but that was really a delight. Anyway, I had my first drive in an electric car. I had to drop off my daughter's car, as I've told you, for some remedial work. It's a beautiful BMW from 2020. In fact, I bought a pair of them for my kids in 2020, and they're still going strong. And next year, both of them become 25, which means that technically they become a veteran car, which is wonderful because you get a huge discount off your registration. So, be that as it may, I was in a taxi cab with this electric motor. And it's quite a sensation. I mean, they're just incredibly quiet, they're incredibly smooth, and quite literally, if you're used to being a normal petrol gasoline driver, you just think the engine and the note doesn't change because it doesn't have any gears. It's just in the standard one gear all the time. Quite incredible. And I was thinking about the thing that would attract people to electric cars. To me, there's no attraction at all. One of my neighbors has an electric car. It's very smart. It's a Tesla, of course. It's a very nice little car. It's totally silent going up and down his driveway, which we are not quite close enough to hear, but when the wind's blowing the right way, you can. And all of a sudden, there's this little silent car. And I get it. I get the appeal of it to people who commute, who are city dwellers, I guess. But the whole push of electric cars is to make them totally self-driving. And I understand that as well. If you're in the business of trucking and you can get rid of your driver and replace them with a computer, the idea is it would be cheaper, although the price of these things doesn't seem to me to be cheaper. The fact that they need government subsidies and massive amounts of them to sell says to me that the price is not competitive, it's not commercial. And I don't know what other advantages there are. I guess when you think about the push for self-driving cars, so many people are interested in it, it's because they want the function of being moved from A to B in privacy and comfort, but they don't want to learn the process of doing it. They don't want to invest their time or their effort in it. To me, I think that's a great shame. The joy of driving a fine motor car is one of the great joys of modern life. But I often see the same thing in trading, that I'm not sure how many people really want to commit themselves to learning the marvels, the mysteries, as I call it, the magic of trading. I think the push is like the self-driving cars, just show me the next trade where I can make some money. And that's a shame, because the more you learn about trading, the more opportunities you're going to see. And there are opportunities that you're just not aware of. That's what we're going to talk about in this new program, Tradecraft, which we'll launch over the weekend. On Monday, you'll see a new tab on the website. It's simply called Tradecraft, and it's going to be a series. It's a chart-based program, like our algorithm program, which I'm going to talk to you about later. I'm going to go into these areas of probabilities that perhaps not something that you'd be directly related to, but take the next week, at least the free week, and have a look at the charts I'm going to post under the Tradecraft tab. You'll get a lot of insights that you may not have been aware of before. So that's the new program starting next week, folks. Okay, so let's talk a little bit about Tradecraft. Tradecraft basically means use all of your knowledge, combine that depth of knowledge to go with the final trigger, which is is it a buy, is it a sell? If so, where's my entry, where's my stop, where's my risk, etc. So what I'm showing you here is one of our 6-day charts. I've been doing these for a few months now for a pretty select group of people, those that are on the Danielcode website Super subscription, which is the $4.99 a month subscription. And as it's called Super, you get everything at the website, including the 6-day charts. And what's been apparent, and for those of you who've been getting them, I don't know how carefully you've been looking at these turns, but the numbers on the 6-day charts, they look the same, don't they? They've got the blue lines, which are extensions of previous ranges, and the red lines, which are retracements of previous ranges. Just the same as the daily charts, but of course, you're looking at entirely different points, because with the 6-day charts, you're getting the major swings, some of which you don't see on the daily charts. For example, some markets, oil for example, they have massive forward trading, massive hedging going on. So when you switch to a new contract, as the contracts roll over, there's a whole lot of data there. Other contracts, like the equities in particular, when you and T-bonds, funnily enough, when you switch to a new contract, there's not a lot of data there. And what is there is a whole lot of dots where the market created a one price for the day, either the open or the close, doesn't matter which. All you see is a dot, and for most people, they don't understand how to use that. Those of you who are regular tutorial or webinar guys and gals, as most of you are, will remember some time ago, maybe years ago, I took one of those markets with just the dots and showed you how they actually forecast significant highs and lows as the market moves along. Excuse me. Lovely cup of coffee. It's morning here in Australia. It's pretty late morning. It's 10:30, 20 to 11 for us, but of course that's a very, very good time for coffee. So this is the 6-day chart of gold, where every bar is created of 6 trading days, and the days when those bars finish is pretty much random, because it depends how much data you've downloaded from Trade Navigator or whoever your data provider is. And most of us will have data packages starting on many different days. So it's automatically counting off at 6 days to end the bar, but it'll be different on different chart packages. The strange thing is, another one of the mysteries of Danielcode, is that doesn't seem to matter. Logically, you would think if I've got a different start date, the days, the 6-day count, 6 trading day count is going to be different, and it is, but it still seems to have exactly the same targeting responses, the same what we call target recognition. And the most amazing thing is we use 0.1% as an allowable variance for target recognition. We want the market to find those numbers, either it's high or it's low or on the close, with a variance of less than 0.1%, not 1%, 1/10 of 1%, which is pretty tight. And if you then look at that on a 6-day chart, logic tells you that your variance should now go out to at least 0.6% or more, because of the multiplicities going on inside those numbers, but it doesn't. These things are incredibly accurate. You can see on this chart, this is gold. You've got a major turn, 13 ticks from target. The next turn was 4 ticks from the variance I put on there. The latest high came at 0 variance, exactly at the number. And that was an unusual one because, as I'll show you as we move on the Danielcode retracement tool, which you'll have if you're subscribed to the Danielcode website Pro package. Terry will supply you with that tool. We don't show the 62.5% retracement, which is one of the rule of 8 numbers, in that group because the Danielcode number closest to it is 59.3, and markets will 95% of the time in that range they'll go to the 59.3. If they don't and they slip through it, the next target is the 62.5. So, but that in the default setting of our Danielcode retracement tool, that 62.5% retracement is not switched on. And that's one of the numbers that comes from the rule of 8. So make sure that's switched on. You can see what's happened with this market here. It slipped through the 59.3, so the 62.5 became the next target, and it found that target completely, accurately, with 0 variance. So it was actually right on the same number. There it was. So that's the alternate that we don't usually show, but you must be aware of it because now and again, when the market's not sure what it's doing, it will find the 62.5% number. I call that the NFI number. N stands for no, I stands for idea, F can stand for anything you like, but to me, generally, it's a number the markets will find when there's no confidence in the move either way, and it's somewhere convenient to park it. So how does the market get parked at that number? Well, for the last 45 years, if you wanted to work in a broking house, you had to get a Section 7 license, which amongst other things meant you had to sit some exams, the most ridiculous of which is that you have to learn Elliott wave theory. So as we've been forcing people to learn that for the last 42, 43 years, of course, market makers, when they're not sure what the market's doing, they'll try and park it at one of the Fibonacci numbers. 61.8 is the one that is in this sort of range. But I don't like to use the word never. Never and always are bad words for trading, because trading is about probabilities. There are no certainties. But as close to never as you can get will you ever see a market that actually turns at a 61.8% retracement. It'll either turn at the 59.6 retracement, which is 59.3, I should say, which it does often, or if it slips through that, it will go to the 62.5% retracement. This is just sort of some of the background knowledge that you need to be aware of, and what I call tradecraft. It's just applying the knowledge that you've built up over the years with all these sorts of issues. And very importantly, as you can see here, and you'll see in other charts, be aware of the Danielcode black line number, which is the 89% retracement. And there's a story with that. The first anyone ever saw of the black line for the last 2,500 years, on the assumption that Daniel knew about it, no one else certainly did, until we made the Danielcode website public in late 2007. And that was the first time anyone saw the 89% retracement. And it's deadly. It's absolutely deadly. And it's different to all the other retracements because it has another quality, as well as being simple support and resistance like the red lines are. The black line also is the last level of support and resistance in any major swing, and the markets need to overcome that number on at least a daily close to show you that the market can go higher or lower, as the case might be. So you'll see more of that as we go along. But on this particular 6-day chart, you can see that support for gold is at that 2303.8 number, which has been on that chart since the previous, well, the all-time high up here made about 2 weeks ago there, and a bit more, 3 weeks ago now. And as soon as that high was in, you were able to calculate all of the retracements, including the black line, which is what gave support to that market most recently, like now. Let's have a look at another way of looking at that and what's the benefit of it. We've now moved from the 6-day chart and we've gone back to the daily chart. And this daily chart I will find for you and tell you that the last bar on this chart is actually June the 5th. The last chart bar on this chart is June the 5th, but if you look at the blue lines above it, you'll see one sitting there at 2406.3. In other words, that number was on this chart since the low went in 2 days before this chart was published. This is one of the Danielcode members charts. They're available on the website, and they're updated on weekends and on Wednesday evening. So you can see that this blue line was on this chart well before the market got there. So keep your eye on that as we move along. And you can see here what happened. The day after that, when we were looking at the last bar on it, was June the 5th. The very next day, June the 6th, you had target recognition. And I put that bar on there to show you this is target recognition. That sets it up for a turn. Now there's that blue line which you saw way back in June the 5th. There's that same number, 2406.3. Of course, the same number. It's the same chart, but time has moved on, and we had there a TO3 sell signal in gold, and you got that massive big down bar as the gold reacted to its Danielcode time signal. And it was a TO3 sell signal and a time sell signal as well. Once we had that low in place, we were able to create the next retracement, and in fact there are two lots of retracements in there. There's the major retracement, which goes to the previous high, and the minor retracement that goes to the high 4 or 5 days ago. And you've got two different swings, so you have two different retracements. And what happened is that the market rallied right up to its number at 2355.3, the red line, closed very close to that, only a few ticks away, and look what happened today. There was your sell going down. Why was that? Well, the major trend was down, and the 2 days up wasn't enough to change the time signal. So the market went down and left a gap, so it can now fool about for a few days trying to close that gap if it wants to. But look at the low of today's bar. I mean, none of this stuff is accidental. The low of today's bar was at 2310.9. 2310.9. Look at the black line that's been on there since yesterday, the day before. That black line that I've been talking about is at 2310.2. And if this market is going lower, it has to have a daily close below 2310.2. That's the power of that Danielcode black line. So you can see the opportunities here simply by thinking about what this Danielcode retracement tool can show you. So the numbers on the 6-day charts are actually stronger than the numbers on the daily charts. which is reasonable because you've got much stronger swings. Anything that's making a swing on a 6-day chart is far more purposed, if you like, far more intent than necessarily would happen on a daily chart. And if you go through back through those 6-day charts, those of you who've been getting them, it's just been amazing. It's just one after the other. 5 ticks variance, 6 ticks variance, 10 ticks variance, 0 variance. The 6-day charts are creating the most accurate numbers probably that you've ever seen, unless you were with us back in the day when I was creating 6-day charts on a regular basis, which we haven't done for a number of years now, until recently. One of our clients asked us to do them, and we did, and there's a few others are getting a huge benefit of it now. If incidentally you are on the Danielcode website super package, that's the $4.99 a month package, and you'd like the 6-day chart, send me an email, please, and I'll be happy to add you to the list. And at least one or two of you I know are on Yahoo Mail, and a lot of those Yahoo Mail addresses are not accepting my email. So if you've got another email address, please use it and let me know. And if you're already registered with us, do have a look at updating your personal details so we've got an effective email address that we can reach you on. So this chart that you're looking at, this is crude oil. 9 ticks variance at the recent high. The low came with 5 ticks variance at the close. It's pretty amazing stuff, and it's giving you insights that are not available to others. Have a look at this. Excuse me, this is the S&P 6-day chart. Bit of hay fever down here, folks. It's autumn, start of autumn. It's got cold enough here. For a Queensland boy, it's cold enough. And we shouldn't be having hay fever, but I do, so you do have to forgive me. Have a look at this 6-day chart here. The recent high here has come with just a 4-tick variance. 1 point, 4 ticks out of a number like 5,400. There's 5,400 points in there, and this chart has got it accurate to 1 point. It's incredible stuff, isn't it? And that goes on all the time, all the time. A lot of those turns, you don't see them flagged because they were flagged at the time, and as the markets moved on, those flags have come off. This is US T-bonds, one of the very, very best trading markets you can possibly imagine. And the same thing, 5-tick variance at the low, 1-tick variance from target at the previous high, 1-tick variance from target at the present high so far. And look at that black line number sitting there, 1119 correct 25. The market has to have a daily close above that number if it's going to continue rallying. They're the sort of insights that you can get from what I call Tradecraft. This is showing you one of our black lines, in fact 2 of these black lines, and the black line was what I was talking about for. It's the 89% retracement, and here you have 2 swings from the low to the high, so you've got 2 lots of retracement, and you can see that US T-bond struggled. It tested that number 5, 6, 7 days ago and failed at the black line. Then it went back, and yesterday it just teased itself all the way up to the red line just below the black line, and then ran back down to show it wasn't ready to challenge yet. And then you got some impetus today, and you've now had a daily close above the black line channel. Now remember, that's the black line channel. Black line channel for the minor swing. You have 2 swings. The lower black line channel, the minor swing, it's closed above that, so that's telling this market's free to go higher, and its next major test is going to be at the black line for the major swing, which is 121 correct 2. Is that helpful information? It will be, because have a look how this is all going to fall into place. This is the Russell, and we've had the extraordinary position this week of having a blue line and a TO3 buy in the Russell, which you can see it's got an arrow there to the chart, which is just a couple of ticks above the blue line at 2004.7, which is what set up the blue line and the TO3 buy signal for today. Well, actually for Wednesday, wasn't it? And the interesting thing is we had and we still have sell signals, TO3 and blue line sell signals on the S&P and on the NASDAQ. Now remember, these various sell signals and buy signals we have are valid for different periods of time. The TO3 signals are valid for 2 days, including the day of posting. The blue line signals, which are our stronger signals, are valid for 3 days, including the day of posting. So the sell signals for the S&P and NASDAQ, as I recall, were posted on for Wednesday, so they're valid for Wednesday and Thursday and Friday. So Friday, let me tell you, is rollover day, and some option X expiry dates as well. So we can expect the usual little dramas around that date. But there was your buy signal, and it ran up, charged up to the black line. Look where it went to. It charged up to attack 2093.8, which is the black line for the minor swing. Remember, there's two major swings in here. There's a minor swing and a major swing. It charged up to get that number, got there, had a heart attack, and ran away. Now, why did it do that, and how could you reasonably have foreseen that? Let's have a look. We know that the trend is down. There's all sorts of reasons for that, but it's been down for a considerable period of time. So if the trend is down and you have a buy signal, a TO3 and a blue line buy signal, then by definition that trade in particular is going to be a counter trend trade. Now, there's a whole lot of views about counter trend trading. Some very experienced and knowledgeable people opine that you should not trade counter trends at all, ever. I think that's a ridiculous proposition for the simple reason that all trends start with a counter trend trade and they end with a counter trend trade. So think about that. That's how your big trend moves start, with a counter trend trade. And we trade both ways. We trade the counter trends as well as the return to trends or continuation trend trades as well. This great big rally here, when the time we placed the order, you hadn't seen the bar then, but you placed your buy order 2 ticks above the high of the previous bar, Tuesday's bar. The trade was selected and off it went. It roared up, as I say, it hit the minor black line. That was the end of the party, and it pulled back quite dramatically. So if you understood Danielcode trading, you said to yourself, I know the trend is down. I have a new TO3 and blue line buy signal. I also have a new time signal to buy. I have to put my order on. We never ignore a time signal, but I need to be cognizant that the trend is down, and if I'm taking a buy in a downtrend, by definition, that's a counter trend trade. And Gabe, I know you're listening to this, and that's what you've been working on. That's where the huge benefit of understanding whether your trade is with the apparent trend or against the apparent trend. And give me a second while I look this note up for you. We always take a time trade. We never ignore a time signal for a Danielcode trade, and you shouldn't ever ignore one for your price signals either. And there's a large school of thought, as I say, that says, from very eminent people, you'll know their names, saying, oh, you should never trade a counter trend. To me, that's ridiculous. We should trade every bar, because every bar is an opportunity to profit. That's what markets are there for, to reward us. That's what they do. So going back to where we are on this big buy bar that roared up, that buy was pretty significant. That trade made a lot of money. Have a look at it. It finds it resistant at the Danielcode black line. This is the Russell 2000 we're talking about, folks. And that trade was worth some part of almost $2,900. Pretty simple bit of trading, wasn't it? However, look what happens. If you didn't make the decision that that was a counter trend, then you're probably still in the trade. And you know what happened today? Down it goes, back to just about the entry point. Well, let's have a look what that all means. We know from observation over many, many years that counter trend trades fail more often than statistically they should. Let me repeat that. Counter trend trades fail more often than statistically they should. So we trade trends, continuation trends, and we also trade counter trends. But because we know that the high probability is that a counter trend trade will fail, we use a different technique. For a start, we use a tighter stop loss regime, and secondly, we use a different technique. Instead of having our stop sitting below the low of the setup bar, we use a trailing dollar stop, and we determine that dollar stop as a percentage of the average true range over 29 days. And you can see what's happened here. The percentage that we're currently using and are currently using is about, it's a bit less than $1,000 on this particular market. So with your trailing stop, it runs up with the market, but it never comes back. Same if you're taking a sell with a trailing stop. The stop will run down with the market as far as it can go, but it will never come back. So you're stopped out. If you're using a $900 trailing stop, you're stopped out $900 from the high, which is fine. The market then goes a whole lot lower, and folks who don't know that this is a counter trend trade lose a lot more money. Look what happens with the next day. Look at the open of this inside bar today. Then look what it did. It rallies up. Where did it rally up to? It rallies up to exactly the point at which the discretionary trailing stop was stopped out. What's that telling you? It's telling you that the market knows all about these techniques. Even the techniques that I'm using that very few people understand entirely, the market knows about them, and it has to know about them because that's where I learned it from. I didn't invent these things out of a cloud of smoke or a handful of dust in the air. I learned these things from years and years and years of looking at charts, of looking at markets. And markets do the same thing all the time. And when I say years, I've actually tested the Danielcode time signals on the Dow back to 1924. Think about that. This is a standard pattern that markets do all the time. So if you understood that this was a counter trend trade and you'd taken the tutorial or otherwise learned, because I do talk about it occasionally, to use a trailing stop when you're taking a counter trend trade, you did pretty well. This, in fact, is what you did. You got stopped out with a profit. You got positive slippage on the close, which is always lovely. That's a big deal. And you made about $2,100 on the buy before the discretionary stop hit you out. Very nice. Nice trade. And then for today, you're flat. Look what had happened to you if you didn't know about that. Look what happened to you if you're still in that trade. Look at your entry point at today's close. They're equal. Close enough to zero. That lovely almost $2,900 profit finished up being zero. And that is what I call trained versus untrained. And that's a term, an expression that I use a lot because over the years, having children growing up, there was always a last-minute panic about, oh, Dad, we're going to exams today. And it's all right, I'll take you to the exam center. And what I would say to them beforehand is, it's easy. You're either trained or you're untrained. You've either done the work and you know this stuff, or you don't and it's too late. And if you are trained, exams are just an opportunity for you to show your examiners how well you've studied and how much you know. They're a wonderful effort and opportunity for self-promotion. Show the examiners how much you know this stuff. Trained versus untrained. And trading markets is exactly the same. You are either trained or untrained. And the vast majority of folk are untrained, which is why, as I say, you don't ever need to tie yourself up in a knot about determining trend, because if you've done a tutorial, I've taught you 3 ways to determine trend on one daily bar, but there are many other methods as well. But you don't have to be too concerned about that, because even if you're wrong, you're going to be better than 70% of traders if you've been trained, because most traders are hopeless. They're buying on memes, they're buying on rumor, they're buying on tips, and most of all, they're buying on news. They're listening to CNBC, they're watching Bloomberg. Those guys don't know anything about trading. Their job, they're publishers. They're publishing electronic news. They're making television shows. And they have all the talking heads to give the impression they know something, but they don't know what's going to happen tomorrow. You don't know what's going to happen tomorrow, and you'll be sad to hear I don't know what's going to happen tomorrow. But I know what the probabilities are, so for any bar, I know the orders you should place to get the optimum leverage and value out of those markets, including using a trailing stop when you're taking a counter trend trade. So here's the argument for counter trend trades. Have a look at this. This is a little piece of a chart from UST bonds, and it just shows you a typical lovely big drawdown on UST bonds. But in that drawdown, I put an arrow on the little tiny bar that confirmed the trend had turned down. And look after that. 1, 2, 3, 4 counter trends, all elected, they all failed. In other words, if counter trends fail, that's exactly what we expect, which is why we use a different stop loss technique. These are the sort of things you need to learn. Learning to trade Danielcode is a whole lot more than just learning and creating the signals. What you need is this huge knowledge that comes with it. And talking about learning and creating signals, this is a chart of gold, which is 2 years and 7 months, which is as much as I could squish in without totally obliterating everything. Have a look at those buys and sell. They're all time signals. They're time signal buys and time signal sells. And it's a fairly slow time signal. But you can come away from this examination of this chart and say, every significant turn, either high or low, has happened at a Danielcode time cycle expiry, because we're actually plotting and trading is the expiration of particular time signals, and on the expiration of a time signal, the most highest probability and likelihood is we get a change of trend, at least in the short term. Okie doke. So, folks, we're getting to the end of the financial year, and everyone is into FOMC, EOF, end of the financial year, EOFI. And what we're going to offer you for EOFI is a Danielcode tutorial. Most of you have seen this slide before. It is the best trading system that I know or have ever heard of, that is learning to trade, create, and trade Danielcode time signals. You first of all learn to master Danielcode price signals, which are based on time cycles, and you will then learn to create and trade Danielcode time signals. So we've got 17 days left in the end of the month until we get to 30 June. If you would like to take this opportunity to get yourself prepared to be a seriously elite trader in the second half or the first half of the new financial year, let me know and sign up for the Danielcode tutorial. Links to it are on the website. My normal fee is $7,500. Our special end of financial year promotion will offer you a discount of $1,000 if you can start your tutorial before the end of the financial year. And for the first 3 of you who are fast enough to register by sending me an email saying you're ready to do your Danielcode tutorial right now, we will offer you a further $500 discount, and that will be as cheap as you're ever going to see a Danielcode tutorial. So if it's something you've been thinking about, act now. If it's something you haven't been thinking about, now's the time to start thinking about it. Okay, we've been running these algorithms for you for a while, and I want you to have a look at this and see how just using some basic common sense you can make it a whole lot better. This happens to be the NASDAQ, and you can see there are a significant run down of 10,700, and then a couple of those in red losing trades, and you had then the 2 big up runs. One was almost $14,000. The others at about, it's moved on. I haven't updated this chart, but it's over $9,000. And you can see both of those rallies started up from a failed sell signal. In other words, what you got is the extreme 2-bar trend change. And these lines on here, you don't have to fret about them. The blue line's the highest high and the lowest low of the last 12 days. The black line is the highest high and the lowest low of the last 3 days. And you can see when you've had a break of the 3-day line, then confirmed by a subsequent bar within 3 days. It doesn't have to be the next bar, but it has to be within 3 days, not counting inside bars. That's an extension that is at the absolute extreme of the 2-bar trend change. And one of the high probabilities is that that will reverse. It's tested that level. The probabilities are with the idea that it will reverse. So you should be aware of that and you should be prepared for that. So look at the difference you can make simply by being aware of something as simple as a 3-bar trend change. All of a sudden, we've now got 18,000 as our first run up, and we've got 17,000 on the present run. And as I say, I haven't finished updating this for today, so that's probably up over 18,000 or close to it right now. So you've got 2 trades around 18,000 each, $36,000, and your losses have got exponentially smaller. You've now got a $3,000 loss and another small loss, which I can't see at the moment, but I'm going to see an ophthalmic surgeon this afternoon, believe it or not, because he wants to do something with my cataracts, which I guess is something that comes to a lot of us with age. But simply being aware of the 3-bar trend, it's really, really simple. Look at the difference it makes. It's worth going back and looking at that again, just so that you are totally aware of what we're talking about. This was the previous chart. You've got a $13,700 run up, and you've got a 8,000 something final run up showing on this chart, which should go a bit further because there's another up bar to it. Doesn't affect the down bar. Go to the next bar, and what we did just now, we've just simply taken the 3-bar trend method, and we've put the marks on here where you buy the highs, and all of a sudden you've now got 18,000 and 17,100 plus today's bar. You've got 2 up runs of 18,000 each, $36,000 to go with your 10,700 run down. So these algorithms with a bit of intelligent thought are sensational. Think about that and learn about the 2-day stop. That's what this is. It's a 3-bar stop. And it's using the highest high, lowest low of the last 3 bars. It needs to trigger that cycle, and it then needs to confirm it. And as often as not, what you'll find is it doesn't confirm it. What it does is it denies it. It purposely says, I'm not going there. And that's a very important message in the total message about trend. So simple enough. On this particular chart has got the highest high, lowest low of the last 2 bars in red, because where you start getting big range bars, you need to be your stops to have that little bit tighter. So make sure you're aware of all of that, folks. And eventually, you'll get to the stage of learning how to create and trade Danielcode time signals, and that will take you very close to what I call nirvana, the perfection of getting every trade at every turn, and overlaying that with the knowledge of trend, so you will adjust your stop loss procedures accordingly. This will make you, to my knowledge, one of the super elite traders. These are the guys we have that have created these 4 webinars, these particular links. If you haven't got time to write them down, just go to the Danielcode website, www.thedanielcode.com, and they're right at the top of the landing page. Click on them. The first one's done by Mark L., who's our reigning champion. The second one is done by Amy and Scott from Colorado. And the final 2 are done by Justin, who comes from the Hunter Valley in New South Wales, the Australian equivalent of Kentucky, if you like, where all the good horse studs are. Beautiful. The grass is good enough to eat yourself right there. Do go through these videos, folks. They're probably about 20 minutes each. You'll learn an awful lot. And I want you to learn an awful lot. So that's pretty much us for now, folks. We're a little bit over time. If you haven't already, do avail yourself of a free trial. Go to the www.thedanielcode.com. Click on the free trial button. Just hit the register button. Any issues, contact Terry, support@thedanielcode.com. He will assist you. And finally, I'm obliged to show you our disclaimer, and I'm happy to show you our disclaimer because let me tell you, it's very, very easy to lose money trading futures and Forex if you don't know what you're doing. And most people don't know what they're doing. So get over that. Take the time to learn to trade. Make sure you're a confident trader before you risk real money. And there's a lot to learn. The best way to learn, of course, is shoot me an email and sign up for the Danielcode tutorial. We'll do more than teach you to trade. We'll make you a super trader. So that's us for the day, folks. I'll look forward to talking to you soon. Those of you who want to start off the new year, the new financial year, as a competent, safe and profitable trader, do send me an email. Let me know. We'll get you started as soon as we can. And that's us for the moment. Bye-bye for now. Enjoy your weekend, and I'll look forward to talking to you again in 2 weeks' time. Bye-bye for now.